Hey folks, welcome to Economic Observations. Today is the 12th of August. My name is Chris, and this video is sponsored by the Tanzania School Foundation, a nonprofit near and dear to my heart. There is so much going on in the world. We have the unemployment and the jobs report were released last week, and we're going to talk about those. The Fed is talking about tapering the QE, and we have excess liquidity. And what do all of these things mean for our economy? Let's get started. So let's start with the unemployment numbers. July report came out and said that 975,000 jobs were created, most of them in the hospitality and leisure sector. But what they failed to tell us, if we use today's numbers, which was 375,000 people, first-time unemployment claims, and you multiply that by 4, to give you the month of July, which is on the low side, by the way, it's 1.5 million jobs were lost. So out of the 975,000 that were gained, we have over 1.5 million that were lost. So folks, you do the math. That's 525,000 jobs lost. So what exactly is all the good news? And what kind of jobs? And what is the problem with these unemployment numbers and rates? Well, first of all, it doesn't count for discouraged workers. It doesn't count for someone who is tired of looking for a job, who keeps getting rejected, and they're not looking anymore. It also ignores the marginally attached worker. It doesn't separate between part-time and full-time. It doesn't consider whether people have low-paying jobs, and it doesn't capture the long-term unemployment rate. So they are telling us that the unemployment rate is 5.4%, but folks, we know that number is much, much higher. The real unemployment rate is actually somewhere around 9.5%. They're giving us these numbers of 5.4%, but it is actually much higher than that. Next, the Fed is thinking about tapering the money supply. The U.S. economy is growing at a robust pace, according to Reuters here, and the labor market is rebounding, signaling it's nearly time for the Federal Reserve to start withdrawing its support. Several U.S. central bankers said this on Wednesday. Let me know if you agree. Is the economy rebounding while inflation is running rampant? It says we're closing in on tapering. I don't know exactly when it will be. When we do close in on it, I'm very supportive of tapering and moving back to a normal environment as quickly as the economy allows us to. And that is Mr. Barkin said that. He is one of the Fed chairs. All right, they're waiting for its inflation and employment goals. They seem to think that they are on track of reaching them, and they talk about tapering as soon as next month. We're seeing in other articles that there is excess liquidity. And what does excess liquidity mean? It means there's too much money out there. People, individuals, and corporations don't want to borrow. When they don't want to borrow, when interest rates are near zero, they are not going to want to borrow when interest rates are at 2 or 3%. There has been way too much cheap money. It is flooded. People are holding on to it in the M2 monetary system. This is going to cause a problem because this can lead to a deflationary period, and it can have great ramifications on the whole economy, including the stock market. So we have this excess liquidity problem. And what happens when we have an excess liquidity problem? Let's go to the Seeking Alpha article behind me. See, the Fed has been just pumping money, $120 billion a month. But what's happening now is there's no demand for that money. Even though interest rates are low, either the banks aren't loaning it or people aren't borrowing it. And this can have major implications The Fed's money printing has continued to pace, so much so that the severe market distortions are reflecting it, even for those with badly impaired economic vision. As the U.S. economy is reopening following the easing of COVID restrictions, there is expected to be an increase of demand for money, reflecting in the ramping up of consumer good production to meet demand and therefore the necessary working capital. But looking at the bank credit to non-financial loans and leases, there is no evidence of that happening. So far, the banks do not appear to be keen to lend, or perhaps their customers to borrow. But in an economy hooked by money and credit expansion, the Fed had to keep its plate spinning, which it did and still does by goosing financial markets with $120 billion of QE every month. All right, so this is the problem, right? There's so much money out there. The liquidity problem was foreseeable. You know, we're going to talk about the German mark and how it printed itself out of extinction. The lesson from this and many other stories involve state-issued currencies backed by nothing more than the dwindling faith of the issuer, is that the collapse of currency is always unexpected by its users. And when it happens, it can be really swift. Today, a market awakening will have to accommodate a stock market crisis, a bond market crisis, and the realization that all financial assets are badly mispriced. And if John Williams at Shadow Stats is right, and undoubtedly he is, then a fall in the dollar's purchasing power, currently annualized at over 11%, will require a suitable interest rate to compensate foreign holders. But even in a move less than half, will take out, and it will take out the over-indebted corporations and force the U.S. government to accept cuts in spending that it is simply not prepared to make. Interesting article, but there is too much money out there. Could what happened to the dollar, what happened to the German mark? We'll just have to wait and see. Thank you so much for watching. As always, I appreciate you. Call someone, tell them you love them. Don't forget to hit the like button. Thanks for watching. Have a good evening.